Hi everyone, welcome back to my channel. Have you ever wondered how businesses figure out their actual worth, whether it is a small shop or a giant tech company? Understanding business valuation is the first step in making big decisions. So let's break it down together. So what is business valuation? It is the process of determining how much a company is worth. Imagine you want to sell your car in 2024 14. You'd check its market value, right? The same happens with businesses. It is used when the companies wants to sell, merge and attract investors. It is used when the companies want to sell, merge or attract investors. Please note this point. Um so now thing is, why do businesses need valuations? I think there are several reasons that for that the business valuation are important. So first is selling a business to set the right price. Second is mergers and acquisitions to ensure both parties agree on the value. Third is raising funds. It means that investors need to know a company's worth. Fourth is legal or tax needs. What it means? It means that for settling disputes or filing taxes. Fifth is strategic planning. It helps businesses understand where they stand financially. So there are three main ways to value a business. I think now we will discuss what the approach is and what the method we use to do with valuation. So there are three main ways to value a business. First is asset-based approach. It means that add up what the business owns and subtract what is owes. Perfect for companies with lots of assets. Should I repeat? Okay. Asset based approach add up what the business owns and subtract what is owes. Perfect for companies with a lot of assets. Second is income approach. It predicts future earnings and calculate their present value. This is great for growing businesses. And the last one is market approach, in which com- um compare the businesses to compare the business to other in the same industry. Think of it as checking similar houses when selling yours. So now we will talk important metrics in valuation. Get the valuation right, we look at some important factors. First, revenue, how much the business earns. Second, growth potential, future plans and opportunities. Industry trends, is the industry growing or declining? Market position, how strong is the company compared to competitors? And intangible asset. It means that things like brand value or patents. Now, I will explain the practical application. So let's make this simple with an example. A tech startup wants to attract investors. How they value it? They use the income approach to predict future profits and discount them to today's value. Then they use the market approach to see what similar startups were sold for. This way, investors get a clear picture of what the company is worth. Now, the last thing is why business valuation matters. For the informed decision making, for fair negotiation, and transparency in transactions. So, actually, this would be the question from your side that why does valuation matter? Well, it helps businesses make smart decisions, ensure fair negotiations, and brings transparency to deals. Okay, imagine you buy a house without knowing its price. It would not make sense, right? The same applies to business. So, what key take away? Actually, what have we learned? Business valuation is not just about numbers. It is about understanding the story behind the business and planning for the future. Whether you are an entrepreneur, an investor, or just curious, knowing valuation can open doors to opportunity. Actually, if you enjoyed this video, don't forget to like, subscribe, and share. Let's keep learning together. Bye bye. Take care.